Hello everyone, and thank you as always for tuning into our monthly market update, this time for September 2022. As always, our goal with these videos is to provide you with unbiased, unspun analysis of the Greater Vancouver housing market. If you find this content valuable, please give us a like, a share, and subscribe to our channel on YouTube so that you don't miss any future episodes. All right, with the typical slower summer months behind us, many in the industry are wondering if we will see an uptick in activity heading into the fall market. Unfortunately, the Bank of Canada may have something to say about that. Let's break it all down by taking a closer look at the numbers. Let's start off like we normally do by taking a look at last month's sales figures, which came in at an underwhelming 1,870 transactions, which is almost an identical number to the July figure and a mere 0.9% drop from that month. However, on a year-over-year basis, this represents a 40.7% decrease from August 2021, which is pretty staggering. From a historical perspective, last month's sales were 29.2% below the 10-year average for the month of August. Next, let's take a look at inventory levels, which dropped slightly to 9,662 active listings, which represents a 6.1% drop from August. So, as a result of inventory dropping faster than sales, our months of inventory actually went down last month to 5.2 MOI. Generally speaking, when months of inventory is coming down, that means that supply is tightening and the market is becoming more competitive. So if that trend continues, prices would stabilize and even start rising once MOI dips below 4 months. However, for now, prices continue to trend downwards, with the benchmark price dropping to approximately 1.18 million, which represents another 2.2% decrease from the previous month. So that's the board's HPI benchmark price, and here's what the average sale price for all property types looks like in the region. We are up from $1,168,000 in August of 2021 to $1,190,000 in August of this year, a year-over-year increase of just 1.8%, but down 11.5% from the peak in February of this year, where the average price sat at $1,345,000. But the big news, of course, is last week's rate announcement by the Bank of Canada, which raised its overnight rate by 0.75% to 3.25%, continuing its quantitative tightening policy. This is the fastest increase in rates that we have ever seen. Rates are now 13 times higher than they were at the beginning of this calendar year. And to me, this is an absolute policy failure by the central bank. And it's a failure that will have really negative consequences for many Canadians. All of last year, even when the real estate market was an absolute inferno, the Bank of Canada kept saying, don't worry, you're safe to borrow. Rates won't start going up until at least 2023. They were basically encouraging people to borrow, and with prices surging, many felt that they needed to overextend themselves in order not to be priced out of the market. And now, it seems like the rug is being pulled out from underneath them. I've personally received messages from clients saying they were really concerned about how they're going to make their monthly payments. So this is not a good situation. Why a slower rate increase wasn't implemented a year ago when everyone could see that both home prices and inflation were going absolutely crazy is going to be looked back upon as a potentially catastrophic failure on the part of the Bank of Canada. What we've been seeing from a boots on the ground perspective is basically more of what I've been reporting to you over the last few months. You can feel that sales volume is lower, but there's also a very strong sense that there are still a lot of buyers out there. Our listings are still getting a lot of showings, but buyers are being more selective and they're definitely not going to be paying February prices, but they are lurking. We've also heard from the mortgage professionals that we work with that they've seen a sharp uptick in pre-approval applications coming in, which sounds to me like folks are getting ready and just waiting for a little bit of the dust to settle. We're also starting to hear the words timing the bottom being bandied about both by clients and colleagues, something that I personally believe is a bit foolhardy from a practical standpoint. The fact of the matter is, unique quality properties are still selling. We recently had the pleasure of listing a beautiful $4.5 million home in Langley, a segment of the market that you might think would be struggling in this economic environment. But it was a unique home, and it sold in 6 days for 98.3% of the asking price with 2 offers on the table. And personally, I do think that that's the attitude that a lot of buyers have right now, and that they should have, quite frankly. Rates are still likely going to rise 2 more times this year. Borrowing is not going to get any cheaper, and this idea that rates will stay high for just a short period of time before coming back down is wishful thinking in my opinion. With the dip that we've already seen in prices, I think if the right property comes along that fits someone's needs, I do believe that buyers will start jumping back in and we could see an uptick in activity over the next couple of months. But for now, many are gearing up, checking their watches, and trying to time the bottom. Alright, that's it for me. If you enjoyed this video, please give it a like, share, and subscribe to our YouTube channel, and I'll catch you right back here in about a month's time. Take care, everyone.